Since 2007, there have been dramatic changes in worldwide financial markets. As we all know, the market decline 5 years ago sent most assets down in unison, making it very difficult to find protection from falling prices. Since the lows in 2009, most markets have now recovered and are considered back to normal. But there is a problem. Markets are not back to normal. Hello, this is Chad Karnes, Chief Market Strategist at ETFGuide.com. Thanks for joining me today as I investigate if your portfolio is really as diversified as you think it is. Since the year 2007, there has been a fundamental shift in the relationship asset classes have amongst each other. This is a new phenomenon and is significant for a number of reasons, likely putting your portfolio at risk. The historically low level of correlations amongst assets is what made asset allocation and portfolio diversification attractive historically. Having a diversified portfolio meant your holdings were able to draw gains from certain assets when markets fell and gains from other assets when markets rallied. Generally, a diversified portfolio was supposed to provide more return given overall risk levels. The chart on the screen shows this concept in theory, also known as the capital allocation line, with the dots representing the individual stocks and holdings in your portfolio. The more risk, which is standard deviation, the higher expected return, and by combining all of these you can actually make a portfolio in red that has overall lower risk but still relatively high expected return. And diversification somewhat worked up until 2007. Given the equity market's resumptions of their uptrends, one would also have expected diversification to also have returned to its more normal ways since the 2009 market lows. But there's just one problem. It hasn't. On the screen now, I show two tables. The first table shows the historical relationship among markets, and the second table shows the more recently since 2007. The first table shows the monthly price correlations between specific asset classes up through 2007. Each asset class data is in parentheses in the year next to the asset class. So for instance, the small cap index has data going back to 1987 and the SPY has data going back to 1993. And as another example, how to read this table, between 1993 and 2007, the S&P 500, represented by SPY, and oil prices had an inverse relationship shown by a correlation of negative 13%. Right here I'm circling on the screen. Meaning that through time, typically their prices moved in opposite directions. They had inverse and closer to zero or near zero correlation, and holding both of them in one's portfolio likely did provide some downside protection through diversification. On this table, when a number is negative or close to zero, it means there's little or no correlation between the assets, and that means that you likely would get some benefit by holding both assets in your portfolio. Now skip down to the table since 2007 and notice some of the significant changes in the numbers. The next table shows the same correlation between oil and the SPY. Since 1993, it was negative 13%. Now it's spiked all the way up to 44%. You now get significantly less diversification benefit by holding both of these and most assets in a portfolio. Now I'm trying to pull up, here's what I'm looking for. This final table in the top here shows the changes in the correlation between the two tables I showed previously. And the bottom table is still the correlation since 2007. Every cell in the top table that is highlighted in yellow shows correlations have risen significantly the last 5 years when compared to the previous time period leading up to 2007. That is a ton of yellow and shows that the typical portfolio is actually likely much less protected today than it was even going into the 2007 market crash. If you own exposure to oil prices, along with financial stocks, represented by oil prices and XLF, you're now significantly less diversified than the same portfolio pre-2007. If you own small cap stocks along with financial companies, small cap index and XLF, 43%. versus previously small cap index and XLF, now 77%. So that was a 43% jump in the correlation between XLF and the small cap index since 2007. A correlation of 77 is extremely high, and as we saw in the first chart, and represented by the 43% number, 77 minus 43, that was a previous number of 34% correlation. Unfortunately, though, it gets worse. Do you think the housing market is really in recovery? The very scary reality is that its correlations are also showing that the housing market is not back to normal. Indeed, far from it. If you own multiple homes and think they are providing diversification because of their different locations, you should think again. I did a similar study to the one above on the 20 major housing markets in America that resulted in a very similar conclusion. That analysis is found in a recent newsletter at etfguide.com and shows the unprecedented change in housing correlations. This is not normal and likely shows the recent rise in home prices is built more on speculation than fundamentals. There should be some aspect of local economies, incomes, and jobs driving housing prices, and there doesn't seem to be any of these distinguishing factors anymore since the year 2007. So why should you care? If you're a typical investor and you own a portfolio of sector ETFs, growth plays, and individual dividend-paying companies, you're likely adding very little diversification value by holding all these assets in your portfolio. This table shows that if you own the SPY, the S&P 500, along with energy stocks, you have a 78% correlation. That's huge. XLF, the financial stocks with the SPY, and 81%. Financial stocks with the small caps, 77%. These are huge numbers, and they're significantly larger now than they were pre-2007. And what this means is that the markets basically are all rising and falling in unison, so that owning one of the assets or the other doesn't make as much difference in your portfolio anymore as it used to. Unfortunately, most people won't care about their portfolio's diversification until it's too late, though. As long as the markets are rising, then who cares, right? But what will happen if another such financial crisis occurs? For starters, it's safe to assume that most of these assets will only become even more correlated, just as occurred in the last crisis, and by then it will likely be too late. It also means that in order to find protection, investors need to look at different assets than the typical sector, REIT, energy, or value play their advisor is likely suggesting. Wouldn't it have been nice in 2007 if investors could have known that their diversified portfolios, and I'm putting them in quotes because they weren't really diversified, would have failed them as correlations all went into extremely positive territory? Right now, those same supposedly diversified portfolios in reality are not nearly as diversified as they could or likely should be, and have remained at correlation levels associated with the financial crisis, not at levels associated with historical recoveries. Thanks for joining me today, and for more suggestions on how to protect your portfolio in today's extremely correlated environment, join us at etfguide.com, where our ETF Profit Strategy newsletter shows where diversification can still be found. We also provide a twice-weekly technical forecast and weekly ETF pick that provide high probability profit opportunities, including a recent 500% plus gain in DUST, the inverse gold miners. Thanks for joining me today, and you can also check us out on our Twitter feed at ETF Guide.